Okay, so today's the report on for the 26th of July. Okay, let's start here. 26, correct? Okay. Okay, today I want to talk a bit more about the yield curve because there are fundamental shifts happening in the market right now. Okay, so when one of the most, how would I say, very most used and accurate indicator to detect the entire market is the yield curve. A lot of economists are actually looking at that. To what's happening right now, the yield curve between the 2-year treasury yield and the 10-year yield, whenever they invert, I'll explain detail. When that happens, right, that is not a good sign for the market. And it's right, it's happening. If you can see here, it's not inverting, it's dropping quite a lot. Now, for those that don't know what an yield curve is, basically, just give you an idea now. You're very familiar with FDs, right? So if you put your money in a 2-month FD and a 1-year FD, which one will give you more return? 1 year, right? So what's happening right now is that, let's say if you put money in a 2-month FD, but you're getting more return than a 1-year FD. This is what's happening right now. So when that happens, they only mean one thing, is that the investors' mentality towards the longer term, they are not sure what's going to happen. Short term, they say okay. So that's why they prefer the shorter term. And usually like that means they also think that the interest rate is going to increase some more. So because of this, the mentality change. So this don't make business sense, right? Long term, takut. Short term, not so worried. So when this happens, and there is a problem, and so far the inversion is the deepest since 1981. We're talking 40 over years already now. The deepest, and also almost 1 year old already, this inversion. Now, how deep the inversion does not necessarily mean we have a longer recession or a very bad recession. It only tells you that there is a good chance that the market will go into a recession. Okay, so then because when the short-term rates increase, right, the US banks due to increase in risk increase this, and the US bank raised benchmark rate for a wide range of consumers, commercial loans, including small business loans, credit cards, and so on. And then when all these interest rates increase, of course, borrowing, we see this right now here in our country also. Mortgage also rises, right? But one thing I'd like you to know, since 1955, this 2 versus 10-year yield curve has inverted 6 to 24 months before the market goes into recession. We are in 1 year right now. So probably the longest, another 1 more year, we will see this. And in the last six recessions, a recession on average begins 6 to 36 months after yield curve inverted. So we will see right now. Now, how accurate this thing is that we have 11 recessions since 1955. Whenever we have an inverted yield curve, only it failed. There wasn't any recession. And the last time it did that was 2019. Then after the pandemic happened. So that's why I said get ready. I know everybody is very bullish about market. The signs are there of a recovery, but there might be a correction coming, and they already said that recession already happened, because the recession cannot be decided by whatever you see. It has to be from this NBER. It's a government agency. They're the one that decide, but they also can backdate and say recession already happened, and we are already in a recession. And like what I also mentioned before, we are probably in a rolling recession. Rolling means it's not one time it hit our sector, one by one sector. It started with the tech sector, then it moved to the bank sector, then slowly it moved to others. But there is a possibility that it may have recovered already, slowly recovering right now, the one we went through, or it may go back in again. But the only way here is that let's say for it to move back into something really bad, we have this issue whereby again inflation start rising again. So we really need to look at the core inflations, like for the US, especially the services area, and then the PCE price index, CPI. We need to watch it very, very closely already. So if they were to increase any more interest rates, it really is a really bad thing for overall everywhere. Because don't think that we are far from the US, because the services, everything comes from US. So there's inflation there. They export the inflation out to other countries also. It's the same thing. Everybody suffers. Okay. So that's why I said, well, over here we have to be careful. But then again, these are also best times to put on the investing cap. To me, because when we have this kind of issues, everything drop, it's a good time to buy. Really, really good stuff. Okay. So to give you an idea, right over here, the last time there was an inversion was 2019, and then we had the COVID. There you can see now those whenever it drops below right over here, right? So that's why there's an inverted yield curve, recession happens. Inverted yield curve, recession happens. Inverted yield curve, recession, inverted, recession, invert, recession. But it takes time. So we have this continue in 2019, same thing. And then we also had the rate hiking cycle. And then whenever you see rate hiking happen, same thing. It leads into a downturn in the economy. Because the fact is that, you can, when everything's expensive, you don't spend that much. And right now, everything is like the highest interest rate for the longest time ever. And you all have housing loans, you can feel the pinch. So same with the US. So when it comes to the end of next month, a lot of these people in the US, they need to start paying their what they call the student loans already. So they're going to be really, really hard hit right over here. So we have to be aware of the situation and do proper planning, right?